Well, of course, if the public does get involved in these little gold stocks, you can blow on them and they'll
Hmm.
double in price. So I think that's on your side. But I think we can probably count on from this 15 or 16 cent level where it is with the marketing that you have, it'll almost certainly, even if the market doesn't get hot, take it to 30 cents, or we're going to have to come through a wall of warrants. So it's a double from here, at least the way I see it.
I would be shocked and disappointed if this marketing didn't get this closer to a per ounce valuation that it deserves. And it is early days, but I think your assessment's bang on, Doug. It should get us through there, and I think I've seen it on West Red Lake Gold right now. The warrants are a weapon for them. It's providing that liquidity, and it's providing a chance for buyers to step in a big way at scale. So
Yep,
I agree with you.
yep. It
Mario,
looks altogether looks good to me, but there we have it.
why should an investor buy this stock now? Why not wait until after the drill results that are coming later? Like, why should they be interested today?
That's a great question because the value of our company is not dependent on those drill results. Right now, we're trading at $5 per ounce in the ground. The peers are trading at 50 plus. We should be trading in line with the peers, and I think we should be getting a premium. We are in a tier one jurisdiction. We have a deposit that is demonstrated to not have any fatal issues. And we now have a very pro mining environment in the United States. So you want to buy now because your downside protection is the undervalued nature of Converse right now. Your upside buying now is we hit the lower plate rocks, and this deposit is in a different stratosphere. So you've got a really great value proposition where your downside is quite well protected and your upside is very compelling. And insiders are leading the way. Too many companies love what they have. CEOs take a salary, boards take their options. Who's buying $500,000 worth of stock in the market? We are.
Today, we've got AXCAP Ventures. Now, this company, what's fun about it for me, for this conversation, is that their approach is different than the companies we've spoken to so far. And I think we'll get a little bit different take and different dialogue because of it. Anyway, AXCAP, take it away. Who's first? Is it Blake or Mario? What's up?
Yeah, so I'll start with an intro here, and just to give everyone a little bit of an intro about myself. I'm a technical guy, so I'll really talk more to the technical aspects of what we've built here, and Mario's going to finish off around kind of capital structure of how we've built this company, which is part of the kind of the nuance to why we're a little bit different. But so a little bit about me. I came out as chief geologist from Argonaut Gold most recently, and we brought the Magino mine online. So familiar with bringing projects through development and into production. And then Mario and one of our other co-founders approached me when we were acquired by Alamos Gold to start building this gold consolidation company where we saw a value in underappreciated and unloved assets in Canada and the US that we could really take advantage of kind of the market conditions and start consolidating great projects. And so that's really where the foundation of the business started. And we'll run through the deck to kind of explain where that's grown. So typical kind of safe harbor disclaimer. We're going to make some forward-looking statements, certainly. But really what kind of caught us about a year ago was the fact that the junior markets really seemed broken, that 65 out of 2,600 public listed junior mining companies were trading over $100,000 in volume daily, and it really kind of leaned into the liquidity problem in our space, and it's what we wanted to really tackle head on. So we approached it with this strategy that we saw tons of opportunity in the market where there was orphaned, undervalued assets sitting as non-core projects within companies that were looking for non-dilutive ways to raise money. So we reached out to our networks and started seeing what assets were actually transactable with this approach that we said we wanted to pay for cents on the dollar what's been spent historically. Really looking to acquire projects sub $5 an ounce for drilled off resource ready projects. And through that approach, we put just under 8 million ounces in our portfolio across 3 assets in Canada and the US. So this is really how we plan to create value. We really see drilling as the main value driver in resources, and with our liquidity approach, we're going to have a liquid structure where we can raise funds and continue to advance these assets. So really where we see tremendous value, and our flagship is our Converse asset in Nevada. It really drives a lot of the value here, but it's this real re-rate potential that we have in the stock right now, where we're trading in this sub $4.50 EV per ounce metric, where we see, a lot of peers in kind of the early stage development space trading in this $40 to $50 per ounce range. Really, not talking about an asset that's under a glacier or has, salmon spawning grounds on top of it, but assets in prime jurisdictions, Battle Mountain, Nevada, significant long-lived histories of production in the region, and assets that really have, high potential for advancement. So we see Converse as being the second largest undeveloped gold deposit in Nevada, largest not held by a major. It's 6 million ounce open pit deposit right now. The structural setup hasn't been better, right? We've had relatively flat exploration spend for the last 15 years. Major discoveries have gone downhill. And that's really set up, the structural setup for gold and doing what it's done now, where we've really seen that, over the last year, what's happened in the gold space. You couple that with the majors getting really cashed up, and we see that just building tremendous value for resources defined in the ground. So kind of puts us to our asset snapshot where, as I mentioned, 7.9 million ounces in the portfolio currently, 6.2 million ounces measured and indicated. These projects are well drilled and very advanced. And really puts us at a significant multiple in where we see our peers trading today. Mario can touch on the team in a little bit here, but touch on the assets, and then I'll kind of hand this over to cap table and capital market side to Mario. So on the asset side, Converse is Battle Mountain, Nevada. The trend's done 50 million ounces of production historically. Nevada goes without further ado. Again, the Converse project sits in one of the best postal codes you could ask for, right? It sits right beside SSR's actively mined Marigold deposit and just south of i-80's Lone Tree. Both projects have done nearly 5 million ounces of production historically. Of note, Marigold's proven and probable reserves at 0.47 are about 15% lower grade than our measured and indicated resources. When we look into the resources, as I mentioned, 5.5 million of the 6 million ounces measured and indicated, very well drilled deposit. Super torquey to gold, 8.2 million ounces in a $3,000 gold environment. Got the breakdown on the redox state here where this project has very advanced metallurgical studies. It's had a PEA done in a $1,200 gold environment, and really hasn't seen exploration since 2012. This is where we really see the advantage here, where in a rising gold environment, everything, particularly where we are today, we see tremendous value. But it's non-refractory across the board. This is a heap leach project that we're looking at. Sulfides still leach over 50%, which is less than 25% of the deposit. And so we really see, the low cost potential of developing this project. Again, we kind of look at, where the next steps and where the upside is on this project. So we're actively drilling this with about a 5,000 meter drill program, working to show a clear path towards a 10 million ounce deposit. When you look at this, it's super torquey to gold, the low grade infills to create a really, really interesting dynamic in the current gold environment, but also very, very limited drilling to expand outside of current gold environments. There's also some minor silver and copper in this deposit that we're going to look to monetize when we update some economics later this year. Kind of secondly, in our exploration strategy on this asset, which we're testing in this drill program, we have all the ingredients for high-grade discovery at depth. So Fortitude to the south of us did 1.5 million ounces at above 8.5 grams. High-grade gold skarn within a limestone. And we have all of those same ingredients, and so this is part of our drill testing to really sweeten the picture and provide optionality to have high-grade and a low-grade open pit at surface. So then we kind of go to value creation, right? And I think the Orla Gold Standard Ventures acquisition in 22 is probably where we see the most analogous transaction value. So you see AXCAP sitting in here trading sub 450 EV per ounce, and Orla was acquired by GSV for $63 an ounce in 2022. The project had more advanced, de-risked economic evaluations, but it really provides a clear path for us as to where we need to advance Converse to really unlock the value. Otherwise, similar metallurgical attributes, similar royalty portfolios, and jurisdictionally very, very similar. we want to just briefly touch on some of this. Strip weighted grade, it sits very much in line with other Nevada assets. And so, the grade to strip ratio looks very favorable to pushing this down the development path as well. We'll come back to the cap table as we get a little bit deeper. So I'll touch on the other two assets. They're more where we see exploration growth within our portfolio. Having the basket of assets really gives us optionality for seasonal ability to work projects, as well as allows us to take aggressive exploration approaches on these projects and not live or die by the next drill hole for each one. So Rattlesnake Hills, it's been around for a while. When we bought it, had 100,000 meters of drilling, $40 million spent historically, no resource calculated. That was kind of the main hair that when people asked why. So we did maiden resource, 1.04 million ounces, 60% of that's indicated. It really shows that the main area was very, very well drilled, but really doesn't tell the whole story. So big, broad intersections, 236 meters, 1.9 grams per ton. These are the kind of things that brought us in here. As a technical guy, like this really, really intense system is what's required to produce something like that. It's in central Wyoming, and we really see Wyoming as a very favorable state to progress forward. I was kind of point to US Gold's GK project, where they effectively took it from a science project to a permitted project ready for development in about a 4-year period. And so it really shows Wyoming and how proactive they are towards advancing projects towards construction. It's an alkalic intrusive complex, not to get really technical, but that's the geological setting that this deposit's hosted in, most akin to Cripple Creek in the US. And those similarities are strong enough that this has attracted companies like Agnico, Newcrest, and Evolution to the deal to come and take a couple shots on it. Economic conditions and kind of a variety of other parameters have never made those agreements stick for the long term, but it really shows the potential that this deposit has. It's about 8 of 10 targets on this project that have never seen a drill bit. And so this is really where we see advancing this, is coming in and testing some of the new areas on this project and really changing the paradigm to a project of significant scale. And the third asset we have in our portfolio right now, we just closed recently. It's in British Columbia, Canada. It's called the Newton Gold Project. It's about 150 kilometers south of Artemis's gold project that they just brought online in Blackwater. Fantastic Canadian success story on the development side, right? And so central British Columbia, you can drive a truck right to where the drill rig would park. It's a reasonable cost exploration project that has fairly good relationships currently ongoing. Sits at about 850,000 ounces of gold with about 4.5 million ounces of silver. It has these big bulk tonnage intersections that have really driven our interest, very much akin to what they were drilling at Blackwater, and where we see substantial potential for resource growth. So we have 4 to 5 times the scale of a gold and soil anomaly as the current resource within this small figure. And that's been confirmed by historic drilling. So we need to come in, validate historic drilling, do a little bit of infill, and we see a fairly clear path through the drill bit to expand this resource. Again, it's quite analogous to Blackwater, and that's certainly the model that we're going to look to advance on this project. These projects do have royalties, and it's something we're very transparent about. Converse has 5 to 6% across the board. We're actively in negotiations to reduce that, but we don't see it as a barrier towards advancement. It's in line with a lot of other assets in the state, and certainly can support that type of thing based on our initial modeling. So I'll flip back up to a cap table, and I'll let Mario give a little bit of an introduction in terms of how we've structured this deal a little bit differently and why we think that's a competitive advantage.
Thanks, Blake. A little bit about me. I'm a co-founder of K92 Mining. I have a merchant bank where I bring companies public. We lead with our own orders first. And that's a key theme you'll see here as you do a deep dive into AXCAP. All of the insiders, led by myself and co-founder Tyron Brainback, have bought a significant amount of stock in the market. So we really believe over $400,000 worth of stock has been purchased in the market recently. So what AXCAP was essentially was a response to the broken ecosystem of junior mining. I got sick of seeing these great projects that had great teams that had a good track record, bring them around to Bay Street to finance them. And all the bankers wanted to do was call the hedge funds and do the easiest funding with the sloppiest shareholders. And I just got sick of it. So I wanted to custom build a company that was set up for the reality of our current market. When the life exemption came around, what that ended up being was it provided capital for companies, but typically the financings being free trading had full warrants, and the equity of these companies, the stock would suffer after they would close because many of them lacked the liquidity to absorb the inevitable selling. So I wanted to build something that wasn't going to be surprised by this dynamic and this reality, which is where AXCAP came to be. So on our cap table, what we did, we thought it would be more retail in nature to start. We wanted it to be a bigger structure. With bigger structure means liquidity. And if you're always liquid, you can always finance. If you can always finance, you can always do the main thing that adds value in a junior, which is drilling. The big problem in the sector, though, over the last 10 to 15 years has been most of the companies that are in it are doing financings to keep the lights on. When you're doing that, you're not really drilling for growth. You lose your dreaming ability and your imagination. And so we found a mechanism where we can continually finance. That means we can continually add value. And that's where we got to this structure. So we initially did a founders round at 2.5 cents with a full 5-year warrant at 30 cents. The idea there was to give it a very wide spread out round to retail stockbrokers, high net worth individuals, family offices, and maybe the odd fund. And so with the founder round having a warrant on it, we thought that was attractive because you typically don't see that too often. And everyone pretty much who committed to the founder round also committed to re-upping into our main financing round. What was key, though, was the escrow that we put on this founders round. We did it in slower, lower monthly drips. So 2.5% per month, ranging up to 7.5% per month in terms of the releases, which allowed us to build the liquidity properly to properly absorb the selling over time. We then did a $16 million financing at 20 cents with a full 5-year warrant at 20 cents. And the purpose of that was to give the shareholders who are participating in that round an opportunity to be the main part of the float as we would build up the liquidity. However, one thing to note that did happen completely out of our control, that stock was getting cleared by a prospectus. The prospectus usually takes 30 to 45 days. In our case, it took over 4 months to clear. So we couldn't exactly enact our plan as we wanted to in terms of getting the proper time to build up the liquidity. So literally 2 months ago, our prospectus got cleared. And we were then allowed to put our website live. We were then allowed to talk about the company and the assets that we'd had. However, when the prospectus cleared the financing at 20 cents, there were releases of cheap stock starting to happen. So if you look at the stock, you're seeing definitely some volume increase. One thing we did that I should note that is very key to this company is we transparently stated from day one for any investor that we're going to spend a significant amount of money on marketing. The reason we do that is if we can spend money on marketing and generate liquidity, as I mentioned before, we can always finance. We have announced an ATM at the market facility where the company can sell its own stock from Treasury. That does two things. That lowers the cost of capital for the company, and it allows us to take advantage of our liquidity as we see fit. We haven't used the facility yet, although it is there at our disposal if we want to. But everyone knew the deal getting into AXCAP and what it would be. It would be different. It would be a response to a broken system. Too many people were just lamenting about the system is broken. It sucks. What are we going to do? No one was really doing anything. So we were bold. We thought we could find a solution to do something about it, and it worked. We were able to buy the Converse deposit when gold was trading around $2,000 per ounce. We always had two parts to our model. Phase one was acquire these ounces and drill them. Phase two was to monetize them. We figured we can monetize them by multiple different methods. One, we could spin them out into their own companies. They could go down the traditional development path. Two, we could do asset sales, and we would be more friendly to acquiring companies because we're not a single asset issuer. Since we're not a single asset issuer, we could take paper, we could do all stock transactions, we can put escrow on that even. So we thought we had this period of time where we'd have phase one, accumulate our ounces, drill them, and then down the road, we'd get into phase two. However, the gold price went way too high, way too fast, quicker than we anticipated. So now we have an asset like Converse, which is 6 million ounces in Nevada, trading at the lowest per ounce valuation of any of the developers. And we're having to go into phase two of our model, which is the monetization part. We're in discussions with majors and mid-tiers about rubber stamp type of financing for a 9.9. But simply put, it's our view that the majors and mid tiers, with their reserves being at the lows that they are relative to their production profile, can't ignore 8 to 10 million ounces in Nevada. So that's a snapshot of the structure. We do have a lot of warrants. We do have a larger structure. That is by design. And you're starting to see that liquidity build. We've traded 25 million shares over the past month. That's just over 1.1 million per day. And that's just at month 2 of starting. We're not on any of the analyst comp tables yet. We have started to see all the analysts. In fact, we saw Peter Bell, the Canaccord analyst, who actually worked at Newmont when they owned Converse, and he was the one who really gave us the confidence in our understanding that this deposit is definitely not refractory. So we're starting to do what normal companies do, getting out, seeing the buy side, seeing the sell side, and it's early days, but I think we do have a fantastic suite of assets here.
Okay, awesome. Well, we can get to questions. You guys just, how to raise your hands, click on react, and there's a hand button there if you got a question. One question I had is, given the price rise in gold, do you plan on acquiring more assets now as part of the original strategy? Is that still part of the plan?
Yeah, it definitely is part of the plan. We're seeing a lot. We get thrown a lot of potential acquisitions all the time. One of our focuses was to use our currency in the future for acquisitions, which we do have one now. It's trading, but we did want it to be higher for us to do acquisitions. So we do have a focus as well on buying at $5 per ounce or less. I think that's important because even when gold was at 2000 and we were evaluating acquisitions, the out of touch with reality management teams, it was staggering to see how a company would be no bid, haven't raised money in 2 3 years, and market cap was 2 million and they wanted 20 million for their asset. So we definitely will look to acquire and accumulate the right deposits, but we are pretty strict on what we're willing to pay for them.
Okay, I have to say it's impressive. The volume, 724,000 shares average per day, is way higher than what we normally see. Lawrence, you're up first. Please go ahead. There you go.
Okay. I really, really like the business plan. There's a tendency in the industry to look at projects from what they looked like yesterday and not what they will look like tomorrow. And I've watched this approach play out several times to create billion-dollar payoffs. Your neighbor, SSR, was originally Silver Standard with a mission of accumulating silver ounces. Lumina Copper created billions of dollars from some unwanted copper assets. And another one is Seabridge. People forget that Rudy set off to accumulate gold assets at a time when no one wanted gold assets. He got KSM for almost nothing and created a $2 billion company around that. But in all of these situations, the value creation came primarily from enhancing the value of the projects, not so much from adding ounces. So I think investors looking at your company are going to want to see what you're going to do to enhance the value of the ounces that you already have in hand more than just adding more ounces. Can you elaborate on what your plans are for enhancing the value of the existing ounces?
I think you bring up a great point, Lawrence. That is very true, and that's one of the things. If you flip through our deck, we didn't get to touch on it, but we have several examples of truly the way you build value. I love the Osisko example at Windfall Lake. I remember that was a junior in Vancouver in 2009. Eagle Hill had the wrong people behind it. They had about 900,000 ounces, had drilled about 200,000 meters. And you look at that over 12 years, going to Oband and to the Osisko crew, 1.4 million meters drilled and 2 billion of value created. That's exactly it. So we have announced the drill program. I'll let Blake get into the details of that, but couldn't agree with you more.
Sorry, not to take a lot of time here, but
Yep.
beyond just adding value, I mean, can you improve metallurgy? Can you find areas
Yes.
with higher grades and those sort of things that I think are
So
really going to drive the value creation?
Blake, could you pull up the slide on Converse showing the lower plate rocks and walk them through the thesis here?
So part of the kind of the story in Converse is that it's sat in private equity for the last 10 years. And so there's been a bunch of work that's been done to this project that really the public is not super aware of, or, the broad investment community is not super aware of. So there were half a dozen large diameter metallurgical holes drilled in 2018. And there's an 800-page metallurgical study that was completed in 2018, 2019. It's never really seen public light. And so really that's is our goal, is this drill program we're in the middle of right now is to show a path to a 10 million ounce resource and show that there's still substantial opportunity left in this deposit, both within the near surface resource as well as, for discovery of high grade mineralization at depth. But also it's to kind of put a bow on where we feel the project needs to be to start going back into modern economic evaluations. And so we really look to say we're going to be updating a PEA Q4 of this year. We have an internal model that we run on this project, and feel that the economics today really put this project in a position where it should have that reevaluated in the public realm.
And so right now we are actively drilling. And if you go to the slide before this, Blake, perhaps you could touch upon for a minute just to give the thesis of what we're drilling there and what we're hoping to encounter.
Totally. So even this, a $1,700 gold price took almost every single drill hole that was ever drilled. The deepest drill hole ever drilled was about 700 meters or 2,200 feet. And it ended in mineralization. Showed that this is wide open to depth, where cone can still continue to get bigger, but there are these more reactive beds. This whole thing is moderately flat dipping at about 30 degrees, and there's more reactive beds within it that haven't really been explored laterally. And this is part of what the program is doing, is going to show that there are likely high grade or higher grade components to the mineralization that can be chased at depth.
So we're drilling now. We've got about 3 holes drilled. I think the first results are expected, correct me if I'm wrong, Blake, in a few weeks.
Yeah, we expect to have some results in the public in the next couple of weeks. And again, this slide, part of the reason why we have this is we have several hundred feet of continuity at half a gram. And so it's hard to understate how the ore body here is quite mineable, right? This is a big shovel, big truck type of deposit, and really benefits from the economies of scale that those types of deposits operate in.
Lawrence, does that answer your question?
Yeah, that's great. Thank you.
Okay, perfect. So next up, we've got Nick Giambruno. Please, Nick.
Hi, Blake and Mario. Thank you for the information. The first thing that jumps out at me as an investor in looking in this company is the warrants and the potential dilution. Your shares are trading at about 15 cents. The vast majority of the warrants and stock options become in the money by 30 cents. So that's, a double, not that much. And they're valid until 2029. So I would certainly hope the stock is at 30 cents by 2029. However, that just means the shares are going to effectively, potentially double by then. So that kind of overhang is a concern. And also, so how are you financing yourself for these drill programs, your ongoing expenses? How does that fit into the future warrants, the future share counts? Can you talk about that?
I think it's a great question. And the structure certainly is one that if you're looking at a traditional issuer, you look at that and it gives you pause and you get worried. And I certainly do when I see a larger warrant count. However, I think it's all part of in context of what the actual plan is here. So we do have a lot of warrants. However, we also have an ATM facility. So we raised 20 million over the first 2 raises. We do have capital left from that. So we're fine for now. But if we do get the pockets of liquidity, we can use the ATM facility. However, the warrants were there to provide a built-in financing mechanism. We're all familiar with that is why you do warrants. My view, and perhaps some people on this call disagree with that, is value drives everything first. Now we are in month 2, so I wish it was further down the road and we'd had a lot more time getting out in front of the buy side audience and getting our word out there. But what we have here is a 6 million ounce deposit. When you look at every company that's listed on all of the brokers' comp tables, the average is $50 to $60 per ounce. There's no reason why Converse should not be trading at $50 to $60 per ounce. People, when they look at it at first glance, they'll say something like, "Oh, Waterton got rid of it. It must have been a problem." And I'm familiar with that narrative because it was the same thing at K9 too. Barrick got rid of it, must have been a problem, and that was a problem in the beginning for us overcoming that. And so I think what you see here is a chance for true value to drive things. And one of the things I've learned over the last 5 years, finance, I've probably raised hundreds of millions, is the buy side has shifted. For many on the buy side, liquidity has become a screening tool. When I started in the business in 2008, it was stock picking first. It was value first. It was asset value first. And if things were liquid, great. But that shift has happened over the last 10, 15 years to where liquidity screens out what people are willing to buy. So it's my view that as we get out and we get the word out and we show that we're capable of developing Converse, we're capable of drilling it, we're capable of accumulating resources and ounces and developing them, that we're going to attract buyers who do want to buy something that is trading at the lowest part of the valuation curve on a per ounce basis. And that liquidity will be our biggest weapon. For someone to go on and strap in a $5 million position in the open market in most developers, it's near impossible. You'll move the stock too much. So I factored a lot of this in when I came up with this structure, making a bet that we will attract big buyers who do want to take on big positions as they see the assets that we have and how undervalued they are. And that buying coming into the market will be able to allow for continued entrance of new participants that want to own our stock. So I see the warrants getting taken down as part of that. I follow West Red Lake Gold. I was a shareholder in the 35-cent round, and what I've seen over the last 2 months validates that thesis. They're chewing through those warrants, moving higher as they execute on their plan. And so warrants, although can be scary up front, I do think they can be quite a weapon for a company as you build and execute. If you don't build and execute properly, they are going to be a problem and an overhang. But I mean, if you look at the team we've assembled, our board, our advisory board, we know how to build companies, and this is going to be one of our key strengths moving forward.
Gotcha. Thank you. And what's the timeline for monetization? When do you expect to monetize, and how many shares are you going to have to issue? Whether they're potential shares, warrants, or through the at the market program? How much equity do you have to raise to finance yourself before you hit monetization? And when does that happen?
It's a great question. We're actually having that discussion internally because, to be quite honest, something like Converse, the largest deposit in Nevada not owned by a major, feels like it's more appropriate potentially for a senior US exchange like NYSE listed company that's going down the traditional development road. And that would involve a spin out and potentially AXCAP owning shares or a dividend to shareholders on a new company. So we are actively having those discussions right now as to what that will look like. Right now, we're good for financing. We have received certain offers that are interesting on some of our assets that we may look to monetize as well. But our full focus right now is on developing Converse well, in parallel, having those discussions internally on what monetization might look like because it has happened earlier with this gold price than we thought it would. So I don't have a firm answer on what we're going to do for that, but we haven't used the ATM facility yet, and I don't think we need to. I'll give a quick little example for everyone. I financed a company called Alaska Energy Metals. It's the largest nickel deposit in the United States. And in last summer, between 2 week period in July, the company traded almost 100 million shares from 15 cents to 40 cents. I wish I had an ATM facility in place at that time because that would have provided great value for shareholders with the ability to use it and not destroy the liquidity, but take advantage of some of the liquidity to pull in funds at a lower cost of capital. Typically, the brokerage fee is 2% versus the 7 and 7 type of structure you'll see when you raise money via a broker. So I do think it's great to have in place for when we do need it if the market warrants it.
Okay, great. Byron, you're up next, please.
Yeah, hi. Nick asked and you answered a big whack of my questions, so I won't repeat that part. You guys did really right by me with K92. Me and my readers did very, very well with K92. So right away there's an endorsement for you. I've visited the properties that you guys own out there, and I have memories. I was never that impressed with Rattlesnake Hill, but let's see what you can do with it. The others, yes, there's definite upside. What just my question would be, what is your summer drilling program look like? How many holes? How much money? And did I miss the part about how much you have in the bank? I'm just not sure about that. I don't know if I missed it or not.
We have about 6 million in cash and cash equivalents, including prepaid on the drilling and some corporate expenses right now. Blake, if you want to walk through the details of the drill program.
Yeah, currently fully committed summer drill program right now is about 5,500 meters, averages 1,000 meters per hole into 5 holes that are testing this open pit upside and higher grade component at depth in Nevada. So really, we're about 2,700 meters into that program right now. Expect that to be ongoing for the next 2 months, and we expect results to basically come into market throughout the summer on that.
And from a modeling standpoint, not I mean, not that you know what you're going to find until you pull the core out of the ground, but what is it that you want to find down there that will make it all worthwhile? What would be your ideal press release in terms of this is why we're drilling these holes and this is what we think we're going to find?
Totally. And so, I always look to Fortitude to the south of us as really the goal, which did, this 1.5 million ounces at 8.5 grams. We expect these limestone formations to be anywhere from 20 to 100 meters thick. Pretty good potential for repetition in them. So, the potential for multiple sequences of this formation at depth are certainly there. We know we have the intrusion. We know it's, Eocene age, right? It's the right age with the right fluid composition that has deposited a massive low-grade gold system in the less favorable lithology. So really, it's about hitting that. But directly to answer your question, I would expect somewhere between 20 to 100 meters of 1 gram to 10 grams, and the upside of that certainly in the core of this, and that's what we're looking for is a substantial discovery that would have an underground tenure.
Okay, so yeah, I mean, if you find that, you'll move your needle in a big way. So, okay, I'll end here. Thank you very much. I have I'm surprised in a good way at what you're doing here. It's not that I'd expected anything wrong, but you're answering questions and it's good. Thank you.
Great, thanks, Byron. Brian, you're up next.
Okay. Thanks, guys. I really appreciate your time. This is really interesting for a number of reasons. Nick and Byron, to some degree, answered or asked some of the questions I had. So I think I'd like to try and characterize this and see if you disagree with me on any of these points. You note that you developed your structure and business model because the junior mining market is broken. Yet many would argue, I would say, that the market is broken because of companies pursuing the model that you have embraced. In that, if this model was employed in virtually any market we've had over the last 5, even 10 years, it would be doomed to failure. But as a race to acquire assets and raise capital to acquire and somewhat advance those assets in a market where the rising price is making those valuable where they would not have been valuable in previous markets. It seems like that would be why you're doing this. I mean, is that fair to say that you're racing to get these assets, expose them to buyers, and that this isn't the kind of a share structure or model that would be for a company that you want to have around in 5 to 8 years or so?
Yeah, I think that's a good assessment there because the gold price, if we were forced to pick a timeline when we thought we'd be monetizing assets that we accumulated, we probably would have said 2, 3, 4 years out from when we started, and here we are 8 months out. And so it was very much a land grab. In the last 3 months, make no mistake, the junior gold market has seen the bankers come back, and you're seeing a lot of financings go up. You're seeing things that weren't financeable and didn't get financed over the last 6 to 12 months all of a sudden start to get oversubscribed overnight. And so you're seeing that strength start to flow back into the sector. And so we wanted to be in front of that because when money is available, for a lot of these smaller companies, private or public, it's harder to compete. But when we started this model, there weren't any of those financings happening. It was tough to get the best of breed junior developers financed, and so we've definitely gotten out to a good start in front of that. But that you're absolutely right. It's a bit of a land grab, especially with these ounces that are trapped within companies that even in this good market, we certainly haven't seen the rising tide where teams that aren't very good are getting financed and that sort of thing. The quality is really what's leading the way, which I love to see. I think that's how it should be. So it's very much that situation where it's a race to find the best assets and kind of develop them, monetize them. That's a fair characterization. I would make one other point though on what you've said. I'm not aware of any companies that have done this type of structure before that's very methodically planned out for this market. I am familiar with companies over the years that have done the accumulation, a consolidation model. First mining finance and gold mining definitely paved the way for that type of model. I would argue, though, that they didn't have liquidity as a stated strategy. If they were liquid, from what they were doing, that was a nice byproduct. But here it's a stated strategy where we're going to spend on liquidity measures. And if you look at some of the groups that spend heavily on marketing, the asset base isn't really there that often. It's more of a stock play, and you're not trying to develop. You're certainly not seeing the insider buying like we're doing. You're certainly not seeing the heavy escrows. So I do think that this is a unique model that I hadn't seen done before. Certain parts of it definitely, but I think we're amongst the first to put this all together under one roof with this strategy and really put our money where our mouth is.
Yeah, and with that said, dilution is something you have to take into account. You use Gold Standard Ventures as a model, and that being done in a bad market, I think it came public at about, I don't know, 20, $30 million, and exited at probably 10x or something like that on market cap, but at the same share price that it had IPO'd. So
Fair point. Fair point. You want to see the share price appreciation, and I do understand that. So one of the things, for example, we're talking about is this the ability to monetize via spinouts, via new codes that or a new company that takes an asset and goes down the traditional development road. I also think it's quite possible that we're going to get. Look, I think we all believe the gold price is going higher, and I think with that, you're seeing a lot of the M&A frenzy start to pick up, and tier one jurisdictions are going to be the first to get the majors and mid tiers buying in. And I do think there's a lack of these type of assets around, especially with the Trump administration and the fast track permitting potential that you're starting to see in the US. I think this is going to become very valuable. So I'll pose a scenario that I often think about and excites me thinking about it. As gold goes to 4,000, 4,500, 5,000, and majors really start to feel the pinch to buy and accumulate quality ounces in tier one jurisdictions. If we can sell Converse, for example, for $40 per ounce to a mid tier or a major, even if it's of their paper, that's significant. That's 300-400 million of value. So you've got this dilutionary structure, but then you add in an asset of 300-400 million of what would eventually be cash, and maybe we buy a bunch of bullion with that or something. But I think that reconciles the dilution part as well. But we're only able to do that if we were able to accumulate these assets quickly and develop them quickly.
Yeah, and I think that's a key point, and not to really disparage it. I think it's a bold strategy and one built for a bull market, whereas it did not work for Gold Standard Ventures in a bear market. I don't want to take much more time. Just a quick question on your ATM. You say you have a 2% financing charge on that for the brokers?
Yeah.
You
Yeah.
do sell at a discount to VWAP, right?
Actually, no. There are no. So you can do as simple as placing orders actively with the broker, or you can give a passive order as well, be 5% of the sell side volume or something. There are no VWAP rules.
Okay, thank you.
You're welcome.
Great. Brent, you're up.
Yeah, good day, folks. I come away more impressed than I expected from this presentation. Well done. I've got a couple of technical questions. I guess at Converse, where does the water table sit?
So, good question, and really hit the nail on the head. It's probably the biggest hurdle, if there is a hurdle to permitting it. It's in the basin. So, we're under pediment. This entire deposit's buried, comes to within about 35 feet of surface. So we expect that we would be interacting with a water table to go to depth, and permitting that development is likely viewed as the main challenge to putting this into production.
Right. And I also note that the various ore types, oxide, transition, and sulfide, are really highly mixed. So it's going to be tough to separate those different things out because most of the mineralization is on vertical fractures parallel to the intrusive. So I guess on the whole, you've got to look at best, what, 62% recovery, which drops your average grade down to 0.34 grams. Is
Yeah,
that
so
right?
you hit the nail right on the head. My model shows 61.75 life of mine through all of the states, and exactly that. There is a layered redox state, but then there's also like a shattered windscreen from the intrusion, and so you get mixture of all states throughout the deposit. And then it's part of the reason why it's never been evaluated as a smaller tonnage oxide only heap leach project, because you only get about 50% of that oxide from the near surface lens, and the rest of it is really distributed within the deposit. Even down to 1,000 meters, we're seeing copper oxides in the major faults and fractures, and so you get quite a mixing of that within the deposit.
Okay, and then jumping up to Rattlesnake Hills, I know that one fairly well too. And although that's a great play, alkalic system, the problem there is that there's a lot of post-mineral faulting, diking, which have just chopped up, to my view, any possibility of a coherent ore body.
And that really has been the challenge there to date. Is that it's quite broken, right, and quite disturbed, right? These are old Archean rocks that were part of Superior Craton at one point, right? And so it's certainly the challenge. One of the upsides that we really see on that project are that almost every kind of preliminary aspect of geology and geoscience that you could do has been done to that project, right? It has 7 layers of geophysics. It has soil grids over the entire asset, rock samples, etc., drilling in known and unknown areas. And so, from my perspective, we see it as a prime target to start experimenting with some of this, without being overly cliche, like the AI machine learning type approach to this, to try and generate a little bit of a different exploration approach to the story. Because what's been drilled has been drilled, and I think that part of the story is well known and maybe even a little bit tired. And so we really want to open the opportunity on this project up, and should say there's a lot more to this project than what's currently been defined, and try and use some modern and kind of innovative approaches to do that.
I'll
Uh,
make a comment there too. I think one of the problems in the past with development and considering options there is if you're a single asset issuer and that's your prime asset, you're really hamstrung by what you can do and how creative you can be. With us having multiple assets and Converse being the flagship, I think we can get a bit more creative with how we want to tackle that. And I think there's an opportunity for a mid-tier or a major to come in and provide some of that technical expertise with a theory that they may have. As Blake mentioned, it's had multiple in the past, and we have had some conversations with some majors and mid tiers about potential joint venture opportunities or strategic investments to see if there is a way at this gold price to attack it in a different way to develop it. So I do think that we do have a bit more flexibility than where this has been in the past in single asset issuers over the last 10 years.
Okay, let me throw one more quick question at you. How much do you plan to spend on promotion and who are you going to pay?
So being publicly traded on the CSE, but more so the BCSC requires us to press release everything. So we've press released every marketing agreement to date with full details on each provider, how much we're paying, and how long the contract is. So you can find that on our press releases. To date, we've press released about I believe it's 3.5 million in marketing. High, yeah, and so that number seems scary at first. However, everyone who cut a check every step of the way understood it as spending even up to we've been saying up to 50% of our money we raise on marketing. We're nowhere near that right now. And I've actually quite impressed with the liquidity before we started marketing. We were trading 500,000 to 600,000 shares per day without having to market. So I think we're in about week 2 of the buildup and the ramp up with marketing. We do expect to see that increase with the liquidity, and we're starting to get more phone calls from bigger sources of capital that can start to look at things as liquidity increases. So we're very transparent, nothing to hide. I'm a fan of marketing. I'm a fan of disclosing all marketing and let the prospective shareholders or current shareholders decide if they like it or not. And that's the beautiful thing about our market. Some people hate marketing, and you don't have to be a part of AXCAP. Some people like it and like the liquidity. And I think one thing that most people don't realize is a lot of buy side institutional sources of capital, actually, as a requirement of capital, oftentimes want to see a marketing budget to make sure there is some liquidity in case they get redemptions or things like that, and they do have to exit. In a lot of ways, maybe they don't want to, but that's just the reality of the money they manage. So,
All right, thank you.
you're welcome.
Great. Great. Thanks, Brent. Lau, go ahead.
Blake and Mario, how are you?
Good,
Thank you
thanks.
for the interesting presentation. I'm somewhat familiar with your work, so I only have two questions. I'll spit them out in one breath, if that's okay. So I think you mentioned that you view yourself as a consolidator of stranded ounces, and I think you mentioned that you like buying below $5 per ounce. I'm just curious, are you still seeing deals at that level, or is that window sort of closing? And for the second one, what's the most important internal milestone that you aim to hit in the next 12 months? Uh, the sort of thing that could drive re-rating in the stock.
I think I'll handle the first part of that and maybe a bit of the second. It's certainly getting tougher, but it's wild to think, Lau. It was as tough when gold was at $2,000. People thought they could, like I said, I think I said earlier, an example of 2 million market cap thinking they want 20 million for their assets. So this entrenchment of management teams that doesn't really understand the reality of the market that they're in is nothing that we haven't seen before. And so it is getting a little tougher, certainly, but they're still out there. They're still out there to do. And we haven't reached that fever pitch of the cycle where no one will look at you yet. So we're still going through the potential candidates, and we get shown new potential product every day, new potential assets every day. I'll answer from a non-technical perspective. What I want to see is the catalyst. I would love to hit a big high-grade intersection in the lower plate rocks at Converse. I think that really puts this on another level. That's me personally, but Blake, why don't you?
And just one question about that. What's the time frame by which that will be known or unknown? Like when will that drilling be done that would identify that?
So yeah, I'll agree with Mario that I think when we're ongoing a drill program for discovery, catalysts can happen at any point. Where I see kind of a more systematic value creation is going to happen in Q4 this year when we update a PEA on Converse. But then, Matt, for your timing, like we're actively drilling. We've already drilled our deepest hole, which went to 4,750 feet. We're seeing the ingredients that we require to form something high grade. And so we're very optimistic that the results are going to come back in line with our expectations. And we're gonna have to wait and see for results throughout they're gonna start coming as soon as a couple of weeks and ongoing throughout the summer.
Okay. All right. Ed and then Mickey. Ed, go ahead.
Hey guys.
Hi, Ed.
So, when I look at these projects, one question that comes to mind, and it's sort of a nagging question. It's like, is there a point at which any project actually dies? Because it's just I've seen this, okay, so your business model is to buy projects cheap, right? And to develop them, improve them, and then you have an exit strategy. And I take it that your exit strategy doesn't include going to production, right?
Correct.
Um,
Yeah.
so, so to me, it's like, okay, so one, um, I've like the other guys, I'm very familiar with Rattlesnake, and I've lost money on the Rattlesnake deals in the past through Evolving Gold and whatever. And I've visited the property. I know the problems there. Brent pointed out probably the biggest problem, obviously, right? And but so my question is twofold here is one, I'm not hearing, I get that you want to develop and improve the project and I get that the economics are way better than they were 15 years ago for gold, right? But I'm not hearing any any anything about what you guys know that the previous operators didn't know. You want to take a shot, fair enough. You want to develop the project, you want to make improvements. But what do you right now? What do you know, what do you know that you think the other guys haven't taken into account? And the other uh, part of my question would be, given your business model, how would you suggest that investors value this company?
I'll take the last question first. I think the best way to value this company is on a per ounce basis. Looking at the comps and what they're trading at, if you look at things that are trading at $40 to $50 per ounce, and you look at apples to apples the deposits, you can't find in many of the cases a reason why this is trading below that. And people are first to point out. Perhaps this dovetails into one of your other questions. Oh, well, Waterton got rid of this asset. It must have been a problem. That's why they got rid of it. I faced the same thing with K9 too, right? Oh, Barrick got rid of this asset. They divested it. It's Barrick. They must know what they're talking about. This can't be good. And so I've faced that my entire career, and it doesn't phase me. Blake's probably better to speak to on our interpretation of what we see, but from a non-technical perspective, what excited me, and I'm putting a lot of money into this, so although I don't have a technical background, I want to form an opinion based on the smart technical people around me. And so, what excited me about Converse, for example, was that this was initially kind of developed around $250, $300 gold, and then it was into the coffers of Waterton, and it was $1,200 gold. And last drilled, I think it was 2012 or 2018, and so the interpretation that we're able to make that's different really gives us we get a lot of our flexibility, I believe, from where the price of gold is at right now. And this is not that exciting at $1,800 gold, and we wouldn't deserve to be rated much more than here. But at this gold price and in this gold environment, and I think we all believe gold's going higher, the torque and the leverage that a mid tier or a major has with 6+ million ounces in Nevada, I think you can look at this in a lot of ways. And the water table problem, for example, at 1,200 gold, kills the project. But at this level, there are many ways to solve that problem. So that's my take on it. And one little before I hand it off to Blake comment, we've really focused on low holding costs per annum on a lot of the projects that we've acquired. So we don't want to have a situation where millions of dollars are going out the door every year just to have them under our banner. So that's been a hallmark of us transacting, is making sure that it's not that onerous to maintain them and have them each year as we pay the claims maintenance or whatever the fees are. So I'll hand it off to Blake for the rattlesnake interpretation and potential opinions that we have.
No, and you basically covered it, Mario. Like when to pull a ripcord, right? Like when do you walk away from an asset that is never going to work? And part of this is a basket of assets, so we can be aggressive and we can try different exploration approaches on these projects that people haven't tried in the past. And if they don't work out, we can try a different approach, right? And we're not entirely reliant on one project to be successful. And so that gives us a lot of optionality. And we're just trying to reduce risk across the portfolio by doing these types of things. Um, and so, really, I think that's a big ace in the hole. And then also, yeah, it is this low carrying cost, right? Where we've looked at a lot of brownfield projects And especially in the U.S. with big reclamation bonds, the carrying cost to hold those assets is quite a bit more substantial than these greenfield or mature exploration projects that have never seen production. So we kind of see that as ace in hand a little bit with the portfolio that we've put together, and has been part of the reason why we haven't necessarily moved forward on subsequent transactions because of that. But I've worked projects that have come through this phase, and like to think that we have a reasonable understanding, and we're looking at mineability, at least potential mineability of ore zones, so that we're looking at projects that do have the potential to advance. I've looked at 150 projects over the last year, and we've selected 3 that we think fit those criteria.
And I'll give you a little bit more honesty too. Rattlesnake was our first project, really, and we were in a point at our time where we had an idea, we had a thesis, and we hadn't raised money. We needed to figure out what came first, right? Are you going to raise money and go find projects, or do you have to find a project first and then start raising your money? And Rattlesnake was intriguing to us, and it was transactable, and it gave us our first asset and allowed us to build off the model. So Converse now being in the coffers is definitely a big focus for us. Newton's a big focus for us as well. So I think that's a little bit of color for you too, that it was our first one and we had to have something to get the ball rolling.
Thanks, Chris.
Mickey, please go ahead.
Yeah, thanks for the presentation. I'm curious, with all these U.S. assets, or really your 2 primary assets are in the U.S., and do you not have any U.S. listing? Did I miss that?
We do have a U.S. listing, GARLF, on the OTC, and we're in the process of upgrading to QB.
So you are a bulletin board company at this stage, and you're trying to get a QXBB or
what? We're in the process of that. Yeah.
And can you give me a timeline on that?
I think it's probably 2 to 3 weeks away at this point. It's been going for some time. We do have DTC eligibility
close
as well.
Anyway.
Yes, yeah. We have DTC eligibility though as well, which I think helps too.
Right. Second question, hypothetical question. 90% of juniors will fail. So what would be the number one factor that could cause your company to fail, excluding a downturn in the gold price?
I think we got the model wrong. Our thesis was wrong, right? This game is about having a thesis. Our thesis is this structure with the liquidity and the ability to raise capital continually to advance our assets is the right move, and it's going to allow us to acquire and accumulate, develop, and then monetize. And maybe we got that wrong. That's what would cause us to fail if the liquidity, if our team's judgment of the broken nature of the ecosystem, the necessity for a larger structure, and the necessity for liquidity to fund operations, if we got that wrong, it won't work.
Okay, fair enough. And final question, I'll be brief. To me, the Converse royalty is of concern. Certainly in Nevada, there are deposits with that kind of royalty burden. I think somewhere I saw you're negotiating can you give some insight into you looking at a partial buyback at reasonable price, or what's the nature of the negotiation, if you will?
I think one of the things that gives us comfortability too is what Marigold's able to mine profitably at with their royalty. And you hit the nail on the head. It's not uncommon for Nevada. So there's a couple of negotiation points that we have with Triple Flag. One of them is potentially lowering the royalty on Converse, and in exchange getting royalty, I guess, exposure across some of our other assets. But through the course of that, one of the things that's come up that was a bit of a surprise to us is Triple Flag has told us they don't really have a robust deal flow network of potential new projects that they could offer royalty financing to. So we're working, and I don't know if it's gonna happen, but one of the things we're working with them and trying to get to an agreement on is if perhaps we can lower the royalty on Converse by giving you exposure to other assets and future assets we will acquire, but also we can be one of the key sources of deal flow for you, and that could be a very big positive for them. So we'll see if that does come to fruition, but I think we'll, at the worst case, we'll be able to work out a lowering of Converse and kind of spreading it out across some of the other assets to make Converse more attractive.
Okay, fair enough. Thank you.
You're welcome.
Okay. And just because of the unique position you sit in, Mario, you can expose them to deal flow. So that's a very, very unique
Exactly.
situation. Most wouldn't be able to do that. All right, Doug, your last up, it looks like. Go ahead.
Yeah, very nice presentation, guys. I like to look at these things through the lens of the 9 Ps I put together. And because of the way you've structured this company, 3 of them stand out. It's financing, paper, and promotion, which are all tied together in this. And are you going to have to, besides the roughly 500 million shares of stock that'll be out when the warrants are executed, most of them at around 30 cents, I guess, are you going to need any more money besides what's coming in from those warrants or not?
It's possible that we will. It does depend when the warrants do come in. We also have the ATM facility, but we're also cognizant of strategic capital. I'll give you guys a little bit of color. I'm a bit of a grinder myself, and I don't like to sit around and wait for things to happen. So over the last few weeks, and I posted this on X, I sent cold emails or cold LinkedIn messages to the CEOs and VP Corp devs and COOs of mid-tier and major companies. And I was talking to them about the optionality of Converse, and they should do a deep dive. And to my surprise, we had 5 of them respond to a cold outreach, wanting to do a deep dive with their technical team. Everything from a $20 billion company down to a $3 billion producer. And I think that speaks to the lack of quality projects that are available. But from that, what I realized is that we do need to be open to strategic capital with one of those types of companies putting in a toehold investment, perhaps a 9.9% stake, because they want a hand in a development of Converse or something like that. So I think that type of situation is something that it should be considered in terms of if we will raise more money. If we hit on the lower plate rocks, I'm sure every banker on Bay Street is going to be throwing money at us, and we'll have the opportunity to choose the right long-term supportive mining shareholder. I mean, they're a rare breed, but they are out there, and they are cutting checks now. So I think that would be a situation where it would make sense for us to take additional capital in as well. And we're also looking at some non-dilutive ways to finance this too. We've had strong interest in some of our assets, so maybe there's something down the pipeline that happens there as well. If we were trading above the warrant strike price, then it would be simpler, but we're not quite there yet. It's still early days, and we're building up the liquidity and the market.
Okay, and that leads me to the second part of my question. Actually, it's that here we are trading at 15 cents. The warrants are at 30 cents. You guys have already paid for, I believe. You said about $3.5 million Canadian worth of promotional programs.
Yeah.
And of those, how much have been put into effect so far?
Yeah, maybe 5%. I don't even think we're that high. Because what you do, and it's a bit of a misunderstanding in the marketplace. We are required by law to press release the entire budget when we sign a contract with a marketing provider. And so we press release that, but that doesn't mean that money is already spent.
Oh, I understand.
Money may go to the marketing groups themselves, but they have a ramp up process. And one of the things my company does, Commodity Partners, is across all of our client companies, we definitely sift through the marketing providers and make sure we're getting strong ROI and strong return. And part of that is working with the groups that are good stewards of your capital. And so the groups that we've hired, they're doing ramp up periods where they test their marketing and they want to see an ROI more than anyone before spending the money. And so everyone would love to believe that we announce marketing and then boom, it's going, it's flying. But there's a methodical ramp up process, which is anywhere from 2 to 4 weeks, depending on the group, to really build that. And that 2 to 4 week process didn't start the day of the press release. The day of the press release meant we could pay the groups. And from that point on, they have to create the content. They spend a lot of time with their copywriters talking to Blake, talking to the rest of our team to really formulate the right narrative and the right way to pitch the project. They want to understand the project. We had some of them go down to site and film videos of the project. Blake was featured in one with a company called Pinnacle Digest. So there's this methodical ramp up procedure that has to happen. So that's why I say maybe 5% been deployed so far.
Okay, that makes sense. Now, that money has already been paid, so it's been debited from your bank account. That's good. Over how many weeks or months will that promotional campaign be deployed?
It's a good question, and it's a bit fluid depending on the ROI that we're seeing. If we had started marketing, call it a month and a half ago when the trade war headlines were happening and risk off happened and the sentiment was really bad, probably not much would have been spent at all. Now we've seemed to have gotten in front of that on the macro level. So it's really down to if the ROI is there, we'll continue to spend and ramp up. And it's dovetails in with corporate goals, depending on what we're trying to do on the company side. So if we hit a big hole in the lower plate rocks and we want to drill more, if we, so it's tough to answer exactly when it will be deploying because it is dependent on a few factors of which we don't fully know yet. If everything goes according to plan, I'd say that we're already trading an average of 1.1 million shares per day. I would love for that to get closer to the 2 million per day range. I think when you're consistently in the 2 million plus per day range of trading, the high frequency traders and the algos are going to pick up on you as well. You're going to increase that trading liquidity there too. And so that would be the target range to get to on a consistent basis.
Okay, so the ideal scenario, of course, is that you get lucky in the drilling and the market takes the stock up, exercises all
Yes.
the time. But I guess the way we have to play this is as you gradually, not all at once, or maybe not even, maybe one at a time, are you going to activate these different marketing
Yeah, they've
formats?
all been started to be activated now,
Okay,
and building
so
up and ramping up. Well, I'd say probably 80% of them activated.
okay, so ideally, what we're looking for is the end phenomenon of those is going to be getting the stock up to the 30 area and already exercising a lot of the warrants, right? That's the way it
Yeah,
should be.
I think my view on marketing is perhaps different than most people's view on marketing. I've just learned it over my career. I would love marketing budgets to be a mechanism where you can spend it and the stock goes up. I've just, in a realistic way, not encountered many groups where that's possible. I know a lot of people like to claim that that's what's going to happen, but the marketing groups you hire, they can only be responsible for what they have control and influence over, and that is the buying that they're able to bring in. They can't control the selling that meets that buying. So what I view marketing as is liquidity, and what I look
Volume.
for is volume. And so I see what we're at on a leading up to the start. If we're already trading 500,000 shares per day and we're say 200 trades per day on average, that's where I need to see an increase from. As long as I'm seeing that, that means that the incremental dollars coming in from that spend is quantifiable. I wish there were groups I could hire that we press the button and it means stock goes up. I'm just a realist now with marketing. It's liquidity and volume, but when you have more buyers and sellers, your stock's going to go up. And I think one of
Well,
the good things about marketing too is the eyeballs are going to be on this company for if we do have a big drill hole, it's going to amplify that effect in our aftermarket.
well, of course, if the public does get involved in these little gold stocks, you can blow on them and they'll
Mm-hmm.
double in price. So I think that's on your side. But I think we can probably count on from this 15 or 16 cent level where it is with the marketing that you have, it'll almost certainly, even if the market doesn't get hot, take it to 30 cents, or we're going to have to
Uh,
come through a wall of warrants. So it's a double from here, at least the way I see it.
I would be shocked and disappointed if this marketing didn't get this closer to a per ounce valuation that it deserves. And it is early days. There's a lot of frustration, certainly from certain people that see it and won't wish it was happening right now. But I think your assessment's bang on, Doug. It should get us through there, and I think I've seen it on West Red Lake Gold right now. The warrants are a weapon for them. It's providing that liquidity, and it's providing a chance for buyers to step in a big way at scale. So
Yep.
I agree with you.
Yep. Yep. It
Mario,
looks altogether looks good to me, but there we have it.
Mario, it's EB Tucker. I don't know if you can
Hi.
see me. Yeah, most everything's been covered, but I just wanted to congratulate you on putting together the deal. It's very interesting, and I like the $4 an ounce or whatever, this like little number that you give. I think you just need things that are unique and different, like to tell the same. So coming up with like kitschy things like that, I think is really important, because the fighting over the same tiny goldfish bowl of investors is, like, as you pointed out, is not even feasible anymore, right? I mean, it's ridiculous. But I think there is a new crop of people that are open to these types of things, and I think those are the things that might bring new participants in for you, instead of the same old stuff. I mean, even the less technical things that make your, getting some of the parts, changing that to, like, we have a dozen of these things or whatever. This is our model. We have like something's always hitting. I mean, you have all these like things that you can focus on that I think are different. And that's probably who will succeed, is like people that can be different with something new, instead of like, beating around the like prospector tent or whatever, kind of like the same old thing from the 80s. So yeah, I mean, that's the deal. And it seems like you're realistic about the challenges, at the moment, and preparing for, people to come in and get involved. So.
Well, thanks.
Cool.
I appreciate that. And one thing that I realized as you were saying that is, well, one thing that we will have once we get drilling going at Newton as well, and some at Rattlesnake eventually, is consistent news flow, which new investors love to see, whether they're the traditional mining investor or the new age investor that's diversifying from something else into looking at mining. They want news flow, and I think that's a unique thing that we'll be able to have a lot of.
Okay,
And
great. Go ahead.
one other thing I just observe, it's that 250 million warrants at 30 cents would bring in approximately $80 million of capital. And if you can get them exercised, spending $3.5 million on marketing is a real bargain.
Doug, you sound like me when I was talking to my co-founders about building this company.
Oh, listen, I wish you
You're
well.
hired.
I really do.
Well, let me
Thank
say
you.
this, before we just have Mario, have you and Blake step off and we'll discuss privately. I just want to ask you one question. Why should an investor buy this stock now? Why not wait until after the drill results that are coming later? Like, why should they be interested today?
That's a great question, because the value of our company is not dependent on those drill results. Right now, we're trading at $5 per ounce in the ground. The peers are trading at 50 plus. We should be trading in line with the peers, and I think we should be getting a premium. We are in a tier one jurisdiction. We have a deposit that is demonstrated to not have any fatal issues. And we now have a very pro mining environment in the United States. So you want to buy now, because your downside protection is the undervalued nature of Converse right now. Your upside buying now is we hit the lower plate rocks, and this deposit is in a different stratosphere. So you've got a really great value proposition where your downside is quite well protected and your upside is very compelling. And insiders are leading the way. Too many companies love what they have. CEOs take a salary, boards take their options. Who's buying $500,000 worth of stock in the market? We are.
I'll just add
All
to
right.
that too, right? You missed the first double and your 10x turns into a 5x, right? And that's why you should buy now.
Like
Okay.
that.
Awesome. Well, thank you very much, guys. I really appreciate it. I'll be in touch over email about when we'll be publishing this, but if you don't mind just heading off now and just let us discuss briefly together. So thank you, Mario.
Fantastic.
Thank you, Blake, very much. That was great.
Thanks a lot,
Thanks very
everyone.
much, everyone. Have a good day.
All right, Brent, you were skeptical. You weren't sure about this whole thing. Probably still are skeptical, but what are your thoughts?
I'm not a big fan of optionality plays. My view is if we need gold to get to 5,000 bucks, we're all going to be the richest people in a hellscape.
Yeah.
Um, the deposits I know fairly well, at least two of them, and they're not great. There's lots of crap deposits out there. Um, these aren't crap. They're marginal at best, I think. Um, I'm concerned, and I think we'll hear this from other people about the actual share structure and what really needs to be churned over, and it's going to be based on basically attracting new people into the sector. Um, I can see it can go up, but it's just philosophically not something I like. And
Yeah,
that's
not
just,
your kind of deal.
I like, real deposits that someone's going to buy and I can see the upside there. So that's my opinion.
Yeah, you're into stuff that actually gets produced rather than gets spun off to a producer or a developer.
No, I want something that's so good a developer has to buy it or wants to buy it. I don't think these posits are that good, at least not right now.
Okay, good. What other comments do you guys have?
I agree totally with what Brett is saying. Brent is saying the, the real value here, or the opportunity to create value, is looking at it from a new perspective and finding ways to get more high grade ounces or improve recoveries, that kind of thing, as opposed to just adding more low grade ounces that are marginal. They talk about Marigold as making money, but it covers operating costs. I doubt very much that they would develop a mine at Marigold under the current circumstances, and that's really the key here.
I see. That's good, Lawrence. Thank you. Anyone else? Mickey, let's hear from the
Uh,
geos who know.
yeah, so I know these deposits, and I don't like agreeing with Brent, but he's bang on here. They're they're
Once a
marginal,
year, Mickey,
and
once a
and
year.
and that's not really true. We agree on a whole lot about geology. And it's it's an interesting idea with because well, I'm an old school guy, and I generally look at tight share structures as the thing I want to do. And I could do a very off color joke that's not
At the
suitable
time.
for the public regarding tight share structure and analogy.
You're
So
not
I won't
going
do.
woke on us here, Mickey, are you?
No, not at all. Yeah, you've heard that joke. I generally do not tell this joke in mixed company with females around. But so it's an interesting concept, but for me, it comes down to the projects, and I would not generally want to put my hard-earned dollars into either of these two projects. You look at a company like Gold Mining Inc., which was the longest lived, continues to trade. It's historically got a lot of liquidity, a so-called gold bank. And you look at the number of ounces they've accumulated, and they generally bought all those ounces with very little dilution, very little cash. So, and they have a New York Stock Exchange American listing with a market cap of, I'm trying to do the math here, about $160 million right now. So they've been successful over the years doing that. These projects do not, the number of projects, they've got two really. I'm not a BC guy. I don't think you can develop in BC with the current political climate. So personally, I'll pass on it.
What about people? What about as a speculation as part of the stock performance is his, because that's obviously it seems to be his angle is that he's going to be able to create value because of the structure of it and being able to maybe sell off assets, certainly through marketing to drive the stock price up and volume. Anyone on that side of things? And if nothing else, Nick, you can go ahead.
Well, can I chime in?
Yes, please.
Yeah, uh, I agree I concur with Mickey, I concur with Brent, but I view this, at least in the next, say, 3 or 4 months, as kind of a trade, and it's sort of binary. If they do well over the summer with drilling in Nevada, the stock's going to go up. So, you buy it in right now, I mean, there's something there. I don't know that I would want to get married to this stock or anything like that. I mean, like I said, K92 did really well by me. I mean, in the whole, well, Barrick didn't want it, so it must not be any good. Well, actually, it was a pretty good project, but Barrick was on the ropes. They were ready to file for bankruptcy. They had to jettison a lot of good stuff. This is not good stuff that somebody jettisoned. Like I've been to the Rattlesnake Hills, and I was like, oh yeah, wow. Where are we going with this? But in Nevada, they're drilling. If he finds what he says he's looking for, I could see the stock popping. I don't know that that's a company maker, but I do think that it's an interesting trade in the next couple of months.
Okay, Nick.
Yeah, thank you. Well, first, I don't feel like I got a straight answer to my question about how much he's going to need to dilute to get to monetization. I think he kind of danced around that answer. So that didn't really inspire confidence to me. Second, looking at this just personally, I'm in my early 40s. I have a longer term time horizon, and I'm just benchmarking it for myself personally. Like, am I gonna the risk adjusted rewards of this company versus just holding physical gold? To me, it's not that compelling. I mean, I maybe have a higher bar on these juniors. I understand there's speculative upside, but I believe gold has pretty big speculative upside too, just plain old gold. So measuring it against that and my expectations for that, I would pass on it.
I mean, to his point, these guys are going to, like hose people down with paper like it's the Selma riots or something. I mean, it's going to be a mess. I could almost guarantee you'll do better. Just buy yourself a kilo bar.
Yeah,
and
I think that's an interesting.
Yeah, it's not like it's like awful or something. It's just that like something dramatic has to happen for it to perform. I mean, running TikTok ads and all this stuff it's fine. It's fine, but I mean, like, what's the point? It's not like something's got to happen. Like there are no serious investors in the space to begin with, right? It's like it's not exactly a robust type of setting for companies to begin with, right? So I mean, they have an unbelievable amount of stock they've issued themselves, which also is kind of fine. But it's like, if you're going to come in there, if you're going to take 100 grand and come in there, it's like, what are you doing? I mean, I think maybe there's a class of people that need something to do. Like, so you need something to kind of, to be involved in, to keep attention or something. But as far as like something that's going to actually go up and give you the liquidity to get out, I mean, I would think there'd be any number of more liquid, easier investments, that you could be a part of, like citing Red Lake Gold. I mean, come on, all these companies, like, forget about it. I mean, Red Lake Gold has been like a non-performing investment. Like it is. So what if it's gone up 20%, in the last 2 months or whatever? I mean, the gold price has doubled in the period of time that he's talking about. Like, forget about it. I mean, it's like, it's one of Frank's big deals, and like there's all these, whatever. Lots of people have made lots of money. So I mean, what you want to be is like involved in the company itself, not buying the company with fresh cash. I mean, you want to be like those guys, like with a bunch of 2.5 cent stock and like 6-figure fee structure or whatever. And I don't say that disparagingly. It's like it's a good cushy gig, I mean, but like we're looking at, we don't have that gig. So like we're like, okay, what's got to happen here? I mean, all the people that brought up the technical stuff, it's fair, but like that's usually not what's going to drive the day to day, of that handicaps the odds of something good happening, sure, but like from the day to day perspective, I mean, like there's not going to be any stampede into the stock unless
You
they
don't
do
th-
something
you
dramatic.
don't you don't think with the big advertising spend they have?
Is every person that every like sad person that clicks on one of those ads is going to be met with 8 people that are thrilled that they showed up. And I mean, look, it's it's what they should be doing, but like, which one of those people do you want to be?
No, I know, but I'm just saying if you look at it from a on a short-term basis, maybe Byron, like as Byron mentioned, in the next few months, you could certainly imagine upside from here. Now, I'm not
if they
saying that
if
this
they
thing,
hit something, if something positive happens, if the gold price keeps kicking up, if the ads all work together, sure, you could get 20-30%. I mean, it's possible, but
you don't
like,
think you don't think you can with the marketing spend, as he said, that they could double it from here, getting it to the warrant price?
it's starting to get expensive at that point, and you've got 600 million shares fully diluted. Everybody looks fully diluted. Everybody knows that those shares are going right into the market. So 600 million shares. So is it really a 900 million Canadian company? I don't think so.
No, you're right about all this, EB. All you guys are absolutely right about everything you said. But those shares are going to be parceled out over the next 18 months so that there's not going to be that much paper that's going to hit the buying. And those warrants, nobody's going to exercise them until they hit 30 cents. And the way I see it is that if we have a good gold market, the public is starting to get involved in these crappy little stocks. And let's admit it, all these little stocks are basically crappy. I see it as a good, high probability double trade in the months to come for those reasons.
How about we bet a stake in Jose Ignacio on that? I'll take the under.
I'd
Okay,
take that bet.
okay, done.
I'd take the same
Well,
bet, honestly.
this allows us to hedge our bets or whatever.
Yeah, just
Mickey,
for
please.
The operative question is, yes, what are the risk adjusted potential for this stock, and what is that versus just buying gold bullion?
Well, over a few month period, I think that's the key thing.
Well, here, in fact, I was just looking it up. If you wanted to buy an option on GLD, let's say a 1 year option, today GLD is trading at $300. So if you bought a call option at $300, it costs you $26, right? So if in a year gold went up to 4,000, that would be worth $1,000 or $100 in this case, right?
Right, over a year time frame. Yep.
Right, right. So it'd be so if you want optionality, I think there's better ways to get optionality. But unlike the other guys, I try to find juniors that have some of that alpha, not just the beta, right? And it's the marketing push is yeah, sure, it could give you a double, but frankly, we're not in an easy money environment.
Yeah,
Um,
but I'll tell you what I saw these guys, the same marketing people do with Alaska Energy Metals was actually extraordinary.
Fair enough, fair enough. But to the point where people are expecting other types of investors to come in, the new fresh crowd who's not used to these projects and so forth, right? To that extent, I don't think we're in that market. I don't think
But
it's
no, but they did this 7 months ago or 6 months ago.
mm,
I couldn't believe the way they moved the
all
stock.
right. That
I mean,
that
honestly.
stock that all I see on the Bloomberg is that stock went from 15 cents to 29 and then is now 9. So like, they doubled it with one in July with one big push, and then it's just it.
languished, yeah.
Yeah, they
Yeah,
had bad drill results.
Yeah, look, if you're liquid, if your legend is off, you're ready to go, and they push go on 3 million of marketing spending, and you can sell into that, that's good. So, it's like I've run an ATM before, by the way, like myself. I ran the ATM for Metalla and for Nova Royalty myself, and I can tell you that like those guys they're gonna go wild with any uptick. Which is, they can use the money to do stuff. Okay, fine, but we're stock buyers. Like,
Yeah.
So
I think the bottom line is there's a lot of better shots out there, no better investments out there in the junior space. I think there really is.
Got an acute case of what I call Oz disease. And so maybe they ought to go get an ATX listing.
All right. Anyone else want to say anything else before we wrap up?
No, I was Matt, one thing. I was just wondering, this part of the conversation was being recorded or not?
Yeah, of course.
Oh, okay. So this part as well. Okay.
We publish it all.
Yeah, okay.
The good and the bad.
Unfiltered. Got it.
This is why Mickey didn't tell us the joke.
Got it.
Exactly.
All right. If that's all, well, again, thank you guys very much for being here. I appreciate it. It means a lot to hear from the experts on it. I don't know if the company will like it or not, but I do own some, and I think it's going to go up. I just got to say, that's not a long-term hold, but I definitely see it. All right. Well, thank you guys very much. I really appreciate it, and
Thanks,
we'll see you
Matt.
next time. Take care, guys.
Thanks, Matt.
Thanks.